So that provide us a valuable opportunity to share our knowledge with each other. Actually, we all are experienced professional and practically we learn from each other every day. So this type of program, apart from providing us the opportunity to share our knowledge with each other, so that will also provide opportunity to upgrade our knowledge, to revise whatever we know. As we all are aware, the field of valuation, the field of insolvency, that is having a very wide coverage, and a need of the hour is to update ourselves on a daily basis, because many changes are happening in the world of valuation, in the world of insolvency. So, Divya Jyot Valuation Foundation, they are doing commendable job in this respect. And today's topic that is given to me is on IVS 105, that is evaluation approaches and method. And you all are familiar with that because there is nothing new in that. Without valuation approach or without valuation method, the evaluation may not be accomplished. Any evaluation assignment may not be complete without the choice of the valuation approach, without choice of the appropriate valuation methodology by the valuer. So this session, in a way, that is a revision of whatever we know. That is a recap of whatever we know. So that with that brief introduction, what I will do, I will actually share my PPT. So just give me a minute. I hope my PPT is visible to each one of you. So if you face any issues in visibility of my PPT, please inform me anytime. And my sincere request to each one of you, please make this session as a knowledge sharing session, as interactive session, so that will be in our mutual interest. IVS 105, that is on evaluation approaches and method. So that is our today's topic of a discussion. So as we all are aware, the international evaluation standard, that is divided into two parts. We have the general standard and we have the asset standard. So a meaning of general standard, we all are aware about that. So that will set for the requirement for the conduct of all assignment, including the establishing the terms of a evaluation engagement, the basis of value, the valuation approaches and method, and the reporting. So, compliance with general standard, that is applicable in all types of assignment, because these are designed to be applicable to valuation of all types of asset. So whether we are doing a valuation of the land and building, or whether we are doing valuation of plant and machinery, or security and a financial asset, or we are doing valuation of tangible asset, intangible asset, financial asset, whatever a name we may call it. So all types of asset, the general standard will be applicable, and for any valuation purpose. So whether we are doing valuation for borrowing purpose, for merger and amalgamation, for IBC purposes, for a legal dispute, for a separation dispute. So any purpose you name it, and a compliance with the general standard, that is a mandatory. So that is a mandatory in all types of assignment. And asset standard on the other end, so we all know, so that will include the requirement which are related to specific type of asset. So if we are doing the valuation of inventory, so asset standard related to inventory will be applicable. If we are doing the intangible, so IVS 1210, which is on inventory, will be the related asset standards. So asset standards are actually asset specific. Selection of the asset standard will be based on a type of asset. So that is very important. And these requirements that need to be followed in connection with the general standard. So as we discussed, compliance with the general standard that is mandatory when performing a evaluation of specific asset type. So this asset standard that will include a certain background information on the characteristic of each asset type that will influence the value, additional asset specific requirement on a common evaluation approaches and method used. So apart from the guidance provided in the general standard, asset standard will provide us guidance on additional asset specific requirement. So if we are doing a valuation of financial instrument, we are doing valuation of inventory, intangible asset, business or business interest. So additional asset specific requirement that we can get from the asset standard. So that is about the brief about the general standard and the asset standard. All of you must be aware that the International Valuation Standard Council or the IVSC in the recent past, they have published the revised valuation standard. So if I be the specific, so a revised valuation standard, so these are published on 31st of January 2024. So just a few days back, the revised standards are published, and these are going to be mandatorily these are going to be mandatorily effective from the 31st of January uh, uh, 31st of January 2025. So there is a time gap of 1 year for implementation of the revised standard. For implementation of the revised standard. So a question will come, what choice the valuer will have between these two periods, that is between 31st of January 2025 and 31st of January 2025. So that is the current period. So what a valuer can do. So in that, valuer has two alternatives, either to follow the current valuation standard, which are published on 31st of January 2022, and that became applicable mandatorily, compulsorily from 31st of January 2023. So that is the alternative number one. Follow the current version of the IVS, or follow the latest version or the revised version of the IVS. So alternative number one, that is the current standard. Alternative number two, so that is the revised IVS, and this option is available only till 31st of January 2025, and from 31st of January 5 onwards, a valuer has no option but to comply with the revised international evaluation standard. So we will discuss a brief about the changes in that. If you have gone through that, you will find that in the old evaluation standard, we have five general standard. We have a five general standard, whereas in a new, you will find that we have seven general standard. So that is the major change, compliance with new two additional general standard. Compliance with two new additional general standard. So that is the major change between the old version of the IVS, current version of the IVS, and the revised version of the IVS. So old version IVS 101 is on a scope of work. IVS 102, that is on the process of due diligence, that is investigation and compliance. Guidance on evaluation reporting, so that we get from IVS 103. Basis of value, very important. As its name suggests, that is the base. So that is the foundation, that is the framework on which entire evaluation estimation will be derived. So we all appreciate the importance of foundation structure in a building. So if foundation is strong, entire building will be strong. Same way, if a selection of the correct basis of value, that will provide more authenticity, more accuracy to the evaluation estimates. So basis of value, that is also known as the standard of value. So a standard of value or basis of value, we get guidance in current version of IVS, in IVS 104. IVS 105. So that is our today's topic of discussion, the evaluation approaches and a method. Evaluation approaches and method. So that is the old general standard. And if we go to the new general standard, so we have IVS 100, which is on valuation framework. So that is a newly added general standard, evaluation framework. If you go through the current version, guidance on valuation framework is always already there in the starting or in the beginning of IVS, but now that is formalized in a way of a general standard. So that has been given more recognition now. IVS 101, a scope of work. We all are aware, scope of work. Three documents are very important, and each evaluation assignment, we need to make sure that these three documents, these are actually given a due importance. So document number one, that is appointment letter. So letter is issued by the client, and that is accepted by the registered evaluer. And in appointment letter, the primary terms and conditions are related to the appointment that will be provided. Second important letter, that is the engagement letter. So engagement letter, that is issued by the registered valuer, and that is accepted in writing by the client. And in engagement letter, the methodology, the entire scope of work, including the valuation approaches, method, the documents required, the information that will be based upon. So all those detail, entire actually methodology of valuation, entire scope of work of the evaluation, that will be covered in the engagement letter. So that is a communication number two. Communication number three, related to finalization of scope of work. So that is actually the management representation letter. So through a management representation letter, the client will provide the important document, important information, detailed data related to the valuation assignment to the registered evaluer. So these three documents, the appointment letter, the engagement letter, and the management representation letter, these are very important for a finalization of the scope of work. Then a basis of value, already we discussed. Base means foundation. So that is also known as a standard of value. And there are IVS defined a basis of value. In all, there are six bases of value. And apart from that, there are other bases of value which are recognized under the international evaluation standard. So basis of value, very important. And under basis of value, as we all are aware, we need to determine the premise of value. Premise of value. So guidance on a basis of value, guidance on a premise of value, that we will now get in IVS 101. So earlier that was IVS 104. So now that in a new international evaluation standard that is shifted to IVS 102, shifted to IVS 102. Then we have the evaluation approaches. So a very important guidance on evaluation approaches and method that we get from IVS 103. So earlier that was IVS 105. Now that is shifted to IVS 103. So name of today's session that is as per the old or current version of the evaluation standard in revise that has now become IVS 103. IVS 104 data and inputs and very important guidance. This is newly added general standard and guidance on that is provided a very vital. So earlier that was in a way the investigation and compliance. So that was including that was actually related to data and inputs. Now that is made more specific, how to collect data, how to collect input for evaluation assignment. So that guidance is now provided under IBS 104. 105 that is on evaluation model. So one important development in evaluation model that is related to use of AVM, use of automated evaluation model. So today's world is of automation. Every process is whether that is related to operating activity or any support activity like HR, finance, all are automated. Actually, machine is competing with the man in providing the services. So now, actually, evaluation is also not left behind. So now, use of AVM, automated valuation model, that is formally recognized under the IVS 105. So, what is the meaning of automated valuation model? A guidance on a use of valuation, automated valuation model. So that is now provided under the IVS 105. So that is newly added a general standard. And IVS 106, so that is on documentation and reporting. So earlier, actually, the documentation, so that was part of reporting, but now actually retention of documents are a very important documentation. So guidance on that is now provided under the IVS 106. So that is about the old general standard and the new general standard. Many times actually questions are asked exactly which order of activity need to be followed in a evaluation assignment of order of activity, whether we should first determine the evaluation approach and then basis of value, what order of activity a valuer should actually follow. So probably the reply to that is now provided under the revised general standard, a new general standard. So whenever we come across a valuation assignment, we need to follow these order of activity, starting with the finalization of the valuation framework, then a finalization of the scope of work, then a finalization of the basis of value, and based on the basis of value, we can determine the valuation approaches. We can finalize the evaluation approaches. And then once actually we have finalized the basis of value, premise of value, valuation approach, evaluation method. So based on that, we need to collect data and inputs which are related to the valuation assignment. And once we have collected the required data and input, we need to determine exactly which valuation model we will make use of, whether that is automated valuation model or whether that is manual valuation model. and based on that, we will arrive at the estimate of value. And once we have arrived at the estimate of value, so then we will finalize the evaluation report and finalize the documentation and retention thereof. So that is in brief the order of activity that one should follow in any evaluation assignment. So many times it may happen that valuer first determine the valuation approach and then the basis of value, but that is not correct. And all this very important we should mention in the evaluation report. So that is about the old general standard and the new general standard. And this is the structure of general standard. So that is for your information. We have IVS 100, a valuation framework, 101, a scope of work, 102. So that is on a basis of value, and that is having three annexures. Annexure number one is on IVS defined basis of value. Annexure number two is on other basis of value, and annexure number three is guidance on a premise of value. Then we have the IVS 103 evaluation approaches, and that is having one annexure relating to the evaluation method. Then we have a data and inputs. So that is having one annexure on the ESG consideration. So this is again very important development. Now the consideration of environmental, social, and general consideration, that is now compulsory, mandatory going forward. So actually, you will appreciate that the consideration of environmental, social, and governance. So this is not general. I am sorry, there is some typographical error. So that is social and governance consideration. After Satyam in India, we have become familiar about the corporate governance standard. So that is not new for us, but probably the environmental and social consideration in a evaluation assignment. So probably that is going forward, that is must mandatory, and that is going to be the challenging also. But because you will appreciate measurement of the environmental and social consideration, that is not an easy task. That is not an easy task. So I will suggest you kindly go through this new version of the international evaluation standard, more particularly the guidance on ESG consideration, so that when it is required to be implemented compulsorily from next year onwards, so you are well equipped about that. You are well equipped about that. Whether you are doing evaluation of land and building, plant and machinery, securities, or financial asset, as we discussed, the compliance with the general standard, that is mandatory. So we cannot escape from the compliance with ESG consideration. ESG consideration. Then evaluation model and documentation and reporting. So that is the structure of general standard. Moving forward, the asset standard. So actually, there are 8 asset standard in both the old or current version of IVS and a revised version of IVS. But I will just highlight the major changes in brief. So now actually IVS 300, which was earlier related to plant and equipment, which was related to plant and equipment. So that is now actually plant, equipment, and infrastructure. So how to make valuation of infrastructure project, guidance on that is provided under IVS 300. And another major change that is related to IVS 500. So IVS 500, a financial instrument. So these general standard is rewritten completely, rewritten completely. So there are comprehensive changes in the asset standard related to a financial instrument. You all will appreciate within a financial instrument that is having a very, very wide coverage and practically all types of financial asset that may fall within, or the majority of the financial asset that will fall within the financial instrument. So for SFA valuer, I will suggest kindly go through this revised guidance, completely rewritten, comprehensively amended. So very important to go through that, the financial instrument IVS 500. Apart from that, amendments are there in all the remaining six asset standard, but those amendments are actually not comprehensive in nature. No major changes, but changes are always there when actually a new version of IVS is published. So as we discussed in the general standard, before we go to our today's topic, which is on the valuation approaches and method, we need to first go through the basis of value, because unless we determine the basis of value or a base of a value, premise of a value, so probably we may not be able to choose the appropriate or a correct evaluation approach. So a very important basis of value, and as we discussed, so there are six bases of value which are defined under the IVS. So a meaning of these six bases of value is provided under the IVS. So that is related to a market value. We have the market trend, we have equitable value, investment value, synergistic value, and the liquidation value. So everywhere you will find we have the value common. Ultimately, market trend is also determined based on the market value only. So here also value is there. Then we have equitable value, investment value, synergistic value, a liquidation value. Everywhere that is value, but you all will appreciate as experienced valuer, meaning of this value that is different. That is different. So very important to understand the intricacy of the basis of value or standard of value, which we get in IVS 104. So as per the current version of IVS, guidance on a basis of value and a standard of value, premise of value, that is provided under IVS 104. IVS 104. So that is very important. Now, actually, briefly, we will go. All this is having a very wide coverage. So briefly, we will go through the meaning of each of these bases of value. So market value, that is nothing but the estimated amount. Estimated amount. Very important. A market value, what we are talking here, that is not the actual value, that is not the value at which the transaction is concluded in the recent past. So this is what we are talking here, that is the estimated amount for which an asset or a liability should exchange. Here when we are talking about the asset, so traditionally we understand asset means resources for a future economic benefit. So those resources which are capable of generating future economic benefit for the owner of the asset, owner of resources, so that we generally consider as the asset. But in the terms of valuation, the asset, the word asset, the terminology asset, that will include either the single asset, or that will include the multiple asset, or multiple asset and multiple liability, or the entire business enterprise, business interest. So whatever name we may call it, that is known as the asset. So asset or liability should exchange on the evaluation date. So very important, a basis of value itself recognizes the fact that the estimated amount that is on the evaluation date. Many time questions have been asked, what is the validity of the valuation report? So that validity of the valuation report is on evaluation date only, is on evaluation date only. Uh, uh, as we all are aware, future is uncertain. Future is uncertain. Nobody in this world, nobody in this world is able to predict the future with 100% accuracy. So what valuers are expected to do, that is to estimate the value on the valuation date based on the circumstances, based on the consideration, based on the factor which are prevailing on the evaluation date. And that is the validity of the valuation report issued by the valuer, and that need to be specifically mentioned in the evaluation report. So on the valuation date, between a willing buyer and a willing seller. So if you are interested to learn more about the market value, I will suggest, if you have not already gone through, kindly go through the guidance which is provided under IVS 104. So there you will get meaning of each of these words, like what is the meaning of estimated amount, what is the meaning of should exchange, what is the meaning of valuation date, what is the meaning of willing buyer and a willing seller. So all that guidance you will get from IVS 104. So willing buyer and a willing seller in an arm's length transaction. Arm's length transaction means a transaction between two unrelated parties. Transaction between two unrelated party, that is considered as arm's length transaction. So in other words, the valuer will uh, base estimate on unrelated party transaction, not a related party transaction. So that is very important, and that should be done after proper marketing, and where the parties had each acted knowledgeably, prudently, and without compulsion. So there should not be any compulsion for either of the party to enter into the transaction, to enter into the transaction. So that is the meaning in brief of the market value. Market rent, so meaning of that is meaning of market rent that is identical, that is similar to the meaning of market value. The only difference is the market rent that is used as a basis of value when valuing a lease or an interest created by a lease. So for a leasehold transaction, as we all are aware, the lease rental that is determined based on the market value of the asset, market value of the leasehold property. Many times it is provided in the lease agreement that the annual lease rental that will be anywhere between 6% and 15 percentage, or that can go up to a 20 percentage, 25 percentage also. But normally this is the range between a 6 percentage and a 15 percentage. So annual lease rental that is between a 6 and a 15 percentage of the market value of the property, of the market value of the property. So very important. A market rent may be used as a basis of value when valuing a lease or interest created by lease, and in such cases, necessary to consider the contract rent. Contract rent, as we all are aware, that is the rental agreed to by the lessor and lessee between the two party in the lease agreement. For each leasehold transaction, there will be a lease agreement. So, what rentals are fixed in the lease agreement, what rentals are agreed by the lessor and lessee in the lease agreement. So, that is the contract rent. And normally, in normal circumstances, the valuer will consider the contract rent or rent as per the lease agreement, but there is a exception, so that is and where it is different, so the market rent. So where in other word the lease rentals are different as compared to the market rent, so that is the market rent will prevail, the market rent will have the upper hand. There is, it seems, one question, let me go through that. Can you please tell the difference between basis of value and a basis of value? So that is same, sir. There is no difference. Selvaraj, sir, there is no difference, sir. A basis of value
Okay,
or a
sir. Okay.
BASES or a BASIS or a standard of value, all these words are used interchangeable.
But the ICAS standard, they are using the word basis,
Yes, yes. So,
BASIS.
so that
Only
can be
IVS, they
used.
are used the base.
Yes, sir. So that can be used interchangeably. That is same, sir. Meaning is
Okay.
same, sir.
Okay, sir. Thank you.
Thank you. So a market rent, and then we have the equitable value. So that is nothing but the market value only. Here also we are taking about the estimated price for the transfer of an asset. So here very important, it is specific related to the transfer of the asset. So for any other person or any other purpose, any other reason, we cannot determine the equitable value. So very important about the price we are estimating, that is for the transfer of an asset. That is for a transfer of an asset and or the liability. And here a very important, that is between the identified, knowledgeable and a willing party. So this is a very important. Here actually a market value. The parties are not predetermined exactly between which party this transaction will be undertaken. So parties are not predetermined. Here actually between the identified, knowledgeable and a willing party, and that will reflect the respective interest of those parties. So if we take just one example, recently, as you all may be aware, in the recent past, the merger between the HDFC and the HDFC Bank, so that was concluded. So there actually the settlement of the purchase consideration. So as you all are aware now, the HDFC and HDFC Bank, so that is now actually HDFC is merged with the HDFC Bank. So, in other words, HDFC Bank has acquired the HDFC company. So the settlement of the purchase consideration between the HDFC Bank and HDFC, so that is through the exchange ratio. That is through the share exchange ratio. So what share exchange ratio that is appropriate, that is determined by the registered valuer. And now you can visualize. So that transaction is between identified, knowledgeable, and a willing party. So, in other words, equitable value. Normally, one of the example of that is the settlement of purchase consideration in mergers and acquisition transactions. So, there instead of market value, we determine the equitable value. Investment value, so that is very important. That is actually to a particular owner or a prospective owner. So that is actually, in other word, the investment value, that is owner specific. That is either owner specific, particular owner specific, or a particular prospective owner specific. So if I give just one example, supposing I am residing at a place which is 25 kilometers away from my workplace, that my place of work is 25 kilometers away from my residence. So I need to commute, I need to travel a distance of 25 kilometer each. So total 50 kilometer each day. So you will appreciate that that is actually a very, very challenging. That will put me to hardship. 50 kilometer each way, that is not an easy task, daily basis. So in that circumstances, if I am offered a residence in a complex, in a newly built residential complex at a price of say 1 crore. So I am purchasing 3 BHK residence in a newly constructed complex at a price of say 1 crore rupees. And each of other occupants to that building, that complex, they will also play the price of 1 crore rupees only. But the value of that particular residence, that will be much more to me as compared to other residents of same residential complex. Because by occupying that residence, I will save a commute time of 50 kilometer each day. So that will be more convenient for me. That will be more convenient for me. So that is the investment value for me. I will like to quote here the famous quote of Warren Buffett. So he said, the price which you pay and a value is what you derive. Price which you pay, a value of which you derive. So I am deriving more value from this residence as compared to the other residents of the same complex. So that is actually investment value. That is the value of an asset to a particular owner or a prospective owner for individual investment or operational objective. For individual investment, either that can be personal investment, individual investment, or actually likewise you must have heard about the about the economic of scale in the operational activity. So either that can be personal, individual, or operational objective. Synergistic value, so that is also known as the marriage value. That is also known as the marriage value, and that is actually found mainly in cases of the business combination transaction, business combination transaction. So that is the result of combination of two more asset or interest. So we have taken the example of HDFC and HDFC Bank. So the value of assets of HDFC and HDFC Bank individually, that will be actually less as compared to value of same asset to the combined entity of HDFC. So that is the synergistic value. That is the result of combination of two or more asset or interest, where the combined value, this is very important, where the combined value, that is more than the sum of the separate value. Combine a value more than the sum of the separate value. So supposing there is actually a plant and a machinery. In we can visualize there is furniture, office furniture with HDFC. So that is actually entire building with furniture. That is say 100 crore rupees. A value of that to HDFC and HDFC Bank both, that is 100 crore each. Actually when these two companies are combined, their business is combined. So a value of this need to be 200 crore. But in reality, actually, when a combination is there, a business combination, so value of that will be around 220 crore. So that is more than actually the combined value of this. So that is 20 crore in other word here. So that is the synergistic value. So that is where the combined value is more than the sum of the separate value. So that is the synergistic value. And if synergies are only available to one specific buyer, then a synergistic value will differ from the market value, as a synergistic value will reflect a particular attribute of an asset that are only a value to a specific purchaser. So that is about the synergistic value. Liquidation value, as we all are aware, that is determined when a company is under a dissolution, when a company is undergoing the process of winding up. So there we determine the liquidation value, and that is the amount that would be realized when an asset or a group of assets are sold on a piecemeal basis. So that is very important when we determine the liquidation value. The basic assumption is that the asset will be sold on a piecemeal basis. Asset will be sold on a piecemeal basis. So where actually we are talking about transfer of entire business as a going concern. So a liquidation value, that is not the appropriate basis of value, because there actually the entire business will be sold as a one unit, not on a piecemeal basis, not on a piecemeal basis. And a liquidation value that should take into account the cost of getting the asset into a sellable condition, very important. Many times when company is undergoing winding up, it may happen that the assets have remained in inoperative condition for a very long duration. So whatever a cost is involved to bring that asset back to a sellable condition, that will be considered, that will be reduced from the liquidation value. So that should take into account the cost of getting the asset into a sellable condition, as well as those of the disposal activity. So actually, in other words, supposing there is a factory and there is a very big plant and machinery which is installed in that factory, and that plant and machinery is actually proposed to be sold separately, a building separately, a plant and machinery separately. So that is example of a piecemeal basis. And here actually this plant and machinery will need, supposing a cost of 10 crore to bring that machinery to its operating condition. And before actually a transfer of this plant and machinery to the buyer of that machine. So that will require a decommissioning of the plant and machinery. That will require a transportation cost. So that will be part of the disposal activity. Supposing that is say point 50 crore or 50 lakh rupees. So these two amount will be reduced from the gross amount of the liquidation value. Gross amount of the liquidation value. So that is about the six basis of value. And apart from that, there are other bases of value like fair value as per IFRS, fair value as per the OECD, fair market value as per OECD, Organization of Economic Cooperation and Development, fair market value as per US IRS. Yeah, IRS stands for Internal Revenue Service. So in India, we have Income Tax Department. In USA, they call it as Internal Revenue Service. So they have also provided the meaning of fair market value, and that is recognized for the purpose of taxation in USA and many other countries. So there are other bases of value apart from these six bases of value which we discussed just now. Now we will go to our today's topic, that is on evaluation approach and evaluation method. So first, meaning of that. So if we go to the glossary, clause 20.25, so that will provide us the meaning of valuation approach. A valuation approach. So in general, that is a way of estimating value that will employ a one or more a specific evaluation method. So that is a path, that is a road to estimate the value of an asset. Valuation approach, that is nothing but a specific path, specific road, specific approach of actually determining the value or estimating the value of an asset. So a valuation approach, that is nothing but a way of estimating a value that will employ one or more specific evaluation method. So if I just give one example, supposing actually one a person has met with an a road accident and he has broken his leg, so there is fracture in his leg, knee joint. So doctor will give two alternatives, two approaches of a treatment. Number one, whether to go for a surgery, or number two, actually the plaster that need to be retained for a very long duration. So either to go with the surgery or to go with the plastering. So actually, out of that, these are two approaches. And once the approach is finalized, so supposing actually the patient is saying, I will go with surgery. So again, surgery, there will be multiple method. Like nowadays, we have the robotic surgery. We have a minimum invasive surgery. So within a surgery approach, there will be a multiple method. So same is that we have the evaluation approach at upper level, and in that we have the evaluation method. And here the purpose is to estimate the value. The purpose of valuation approach is nothing but to estimate the value, and that will actually, with the aid of, with the assistant of one or more specific evaluation method. So, what is the meaning of valuation method? Under evaluation approach, we have valuation method. Meaning of that is provided under clause 20.26, evaluation method. So, within evaluation approach, that is a specific way to estimate a value. Specific way to estimate a value. So, I gave you the example of various methods of surgery depending upon the choice of the patient. So that is actually the brief meaning of valuation approach and evaluation method. And very important in evaluation, nothing can be generalized. So a choice of evaluation approach, that will depend on the specific circumstances, the ground reality of each assignment, of the asset and business being valued, and the purpose of valuation. So actually specific circumstances of the asset or business and purpose of the valuation, that will determine the choice of valuation approach and evaluation method. So nothing can be generalized. That is very important. And now we will go to the valuation approaches. So as we all are aware, there are three approaches of evaluation: the market approach, the income approach, and the cost approach. So market, income, and cost approach, and these are recognized globally. These are recognized globally. So whether we do a valuation in India, or whether we do valuation in USA, any of the European country, any of the Asian country, any of the African country, ultimately the evaluation that will be done through three approaches: market, income, and cost approach, globally recognized. And these are applicable to all types of all type of valuation assignment. So whether we do a valuation of land and building, plant and machinery, SFA, again that will be done with three approaches. Whether we do a valuation for borrowing purpose, for merger and acquisition, for financial reporting purpose, for legal dispute, separation dispute, you name it, and ultimately the evaluation will be accomplished through three approaches to evaluation: the market, the income, and the cost approach. Market, income, and cost approach. So, market approach, if we start with the market approach, so as we all are aware, that is known as the relative approach of evaluation. So, that is known as the relative approach of evaluation, and that is mainly actually based, the market approach is mainly based on the multiples and a comparable. Multiples and a comparable. So if we go through the brief meaning of market approach, so that will provide indication of value. So very important, what value we will estimate based on market approach, that is not the actual value, actual transaction value, that is just providing us the indication of value, and that is done by comparing the asset with identical or a comparable asset. Identical or a comparable asset. So comparison, that is how we call it as a relative approach of valuation. So a very important, whatever is the target asset, whatever is the subject asset, whatever is the asset for which we are doing the valuation, so that need to be compared with the identical or comparable asset. So that is not sufficient. And second condition, another condition, that is for which price information is available. So unless actually the price information is available of the comparable or identical asset, we cannot make use of a market approach. So a very important, number one, we actually need to compare the subject asset or the target asset or the asset for which we are doing the valuation with the identical or comparable asset. Not only that, actually that comparable or identical asset need to have information about the pricing, the details of price, the price information. So that need to be available. So that is the market approach. And if we go a little deep into that, so let me take you there. So we all know, actually, you may be knowing this. These evaluation approaches, these three evaluation approaches, these are rooted in the fundamental economic principle. These are rooted in the fundamental economic principle. So nothing new for us, because these three approaches are based on the fundamental economic principle. So if we talk about the market approach, so that is actually based on the fundamental economic principle of price equilibrium, of a theory of price equilibrium. You must have heard about the theory of price equilibrium during your professional journey multiple times. So that refers to the idea that price of an asset or a good, that is determined by the forces of supply and demand. If the supply of a particular good or service, that is more, and demand is less, so naturally in market that particular good or service will command less valuation, and reverse of that, supply is less, demand is more, so that will command more a price. So that is the theory of price equilibrium. So a price of an asset or a good, that is determined by the forces of supply and demand in the market. So if we take just one example, a pandemic, we all actually remember the nationwide lockdown. And in that, actually, if I refer just one, oxygen cylinder. So in our life, we have never purchased the oxygen cylinder, but you will recall that many people actually stand in queue just to buy a oxygen cylinder, and the people were ready to pay the whatever a price is demanded for that just one cylinder, because at that time that was life saving. That was life saving. So that is actually the price of an asset or good, that is purely determined on the forces of supply and demand. And it may happen that at a particular time, the supply and demand for that particular good or particular asset, that can be different. So a valuation method that are based on this principle, that is theory of price equilibrium, that is a market approach. So that will make an attempt that aim to estimate the fair market value of an asset based on how similar assets are priced in the market. So that is the crux of valuation under the market approach. We need to determine how the similar assets are priced in the market. How the a similar asset means asset which is comparable with the subject asset, a target asset for which we are doing the evaluation. So how actually that is priced in the market. Based on that, we will determine the value of the target asset. So very important. And going by the finding of a survey, and generally also you will find the majority of the evaluation, around 80% to 85% evaluation, that is accomplished going by the market approach as the primary approach of valuation, as the primary approach of evaluation. So use of market approach, that is a widespread in the field of evaluation, because ultimately what price is prevailing in the market for a similar asset, that will actually determine the value of target asset, value of a target asset. And a price prevailing in the market, that will always have upper hand, because that is based on the actual transaction, details of the actual transaction, whether that is executed or not executed. So market approach a very important, based on or rooted in the fundamental economic principle of price equilibrium. So that is about the market approach. And if we move further, so we have the next approach, which is the income approach. So income approach, that is also known as the absolute approach, and that is also known as the present value approach. So those of us who are from a finance background, we actually understand that we have already made use of the income approach. Income approach main method of valuation under the income approach. So that is the DCF, and a discounted cash flow method. So that we have made use of that in the capital budgeting decision, when we have found the IRR of a project, capital project, or where we have find the NPV of a capital project, or when we have found the accounting rate of a return of a project. So that is not new. DCF, effectively what we do, we estimate the future case flow, whether that is future case inflow or outflow. So that we estimate the first, and that case inflow and outflow. So that is at a different time frame, at different time frame. So for the purpose of comparison, it is vital that it is important that those different future case inflow and outflow, so that needs to be converted to some common ground. So that is actually we convert that to its present value. That is present value, because if we have actually a cash flow accruing at year end of year one, end of year two, end of year three, and so on. So that is not comparable, because actually for the purpose of comparison, we need to have common ground. We can compare apple with apple, not apple with mango. So some common ground we need to arrive, and that is conversion of those future cash flow to its present value. And that conversion, that is taken place through the discount rate, appropriate discount rate. So appropriate discount rate is nothing but the cost of capital, or that is the minimum rate of return expected by the investor. Minimum rate of return expected by the investor. And that discount rate will mainly have a two component: the time value of money and the risk which is associated with accrual of that cash flow, risk which is associated with accrual of that cash flow. So that is actually the income approach in a brief. We also know that as present value approach of evaluation. So if we go to a brief meaning of that, so that will provide an indication of value. Again, a very important indication of value, that is not the actual value. And how we will get that indication of value? So that will be by converting a future cash flow. So that we actually discuss, that is the first step in income approach, DCF, the estimation of the future cash flow. And once we estimate the future cash flow, so we will convert those cash flow to a single value. So that is the subsequent process. Number one, estimation of the future cash flow. Number two, conversion of those future cash flow to its present value. Conversion of those future cash flow to its present value. So that is the income approach. That is the income approach. And if we go to the fundamental economic principle behind the income approach, so that is anticipation of benefit, anticipation of benefit. So when we are talking about the asset, normally we do the evaluation of asset, and what actually meaning of asset. So that is resources to generate the future economic benefit. So those resources which are capable of generating the future economic benefit, we recognize those resources as the asset of the owner, as the asset of the owner, like land and building, plant and machinery. Why business makes investment? That is for the purpose of generating a revenue in the future. That is for the purpose of generating a revenue in future. In our personal life, that member of family which is earning member, so we call that member, earning member, as asset of the family, as asset of the family, because that earning member will provide economic benefit to the family. Same way, in a business, those resources which are capable of generating the future economic benefit, like investment in land, building, plant and machinery, equipment, furniture, fixtures, electrical appliances, electrical fitting, whatever name we may call it, these resources, investment in that is made solely for the purpose of generating the future economic benefit. So anticipation of benefit, that is the fundamental economic principle based on which the income approach is designed or derived. So anticipation of benefit, that refers to the idea that asset is valuable, as we discussed, because it can generate a future cash flow or the benefit. So unless the asset is capable of generating the future cash flow, we cannot make a valuation going by the income approach. Very important. So a valuation, a method that are based on this principle, like the discounted cash flow method. So that will make attempt to estimate the present value of an asset future cash flow, and that will be how we will actually convert the future cash flow to its present value. So that will be in consideration of the time value of money and a risk which is associated with those cash flow. So that is very important. This is the component number one of the discount rate, that is time value of money, and component number two, so that is a risk which is associated with the cash flow. And this risk, as we all are aware, that is mainly divided into two categories. We have the systematic risk, we have the unsystematic risk. You all are aware the measure of systematic risk, that is beta, and the measure of unsystematic risk, that is alpha. So very important to consider the alpha and beta in formation of the discount rate, in determining the risk which is associated with the cash flow. And a systematic risk, as we all are aware, that is related to the marketplace. So all the companies, a general macroeconomic environment, all the company will be affected by that. Supposing there is a recession, their interest rates are high. So that will make the debt very costly, borrowing money very costly, and all the companies will be impacted by that. So that is systematic risk. That measure of that is beta, whereas unsystematic risk, that is related to the particular asset, a particular company. So if you are doing the valuation of, say, a land and building, and that land and building is actually located at a very isolated place, so that will have more risk as compared to a land and building which is located in the prime area, in the post area of a city. So that is the risk measure, the systematic risk related to marketplace, unsystematic risk that is specific to a particular company or asset, specific to a particular company or asset. So that is a very important. So that is brief about the income approach, and we will consider that in more detail. So that is the cost approach, sorry, income approach. And if we go to cost approach, so that is also known as the asset approach of valuation, and a cost approach. So that is also the residual approach of valuation, residual approach of valuation. So in other words, whenever it is not feasible to derive a value going by the income and market approach, or wherever actually the valuer intend to cross check the value arrived at either through the market approach or the cost approach. So that either through the market or income approach, so cost approach will be used for actually determining the value. So a residual in nature cost approach, and that is also known as the asset approach. So meaning of a cost approach in brief, so that will again provide an indication of value. So I will highlight that in all three, what you are determining is just an indication of value. That is not the final value. That is not the price which is prevailing in the market. As we discussed, price in the market, that will be determined by the forces of demand and supply. So what estimate we are deriving at, that will have no standing in the market if the forces of supply and demand are not considered. So indication of value, and that is using the economic principle that buyer will pay no more for an asset than the cost to obtain an asset of equal utility. So here the keyword is equal utility. Keyword is the equal utility. So you can compare apple with apple. You can compare a mango with mango, not a apple with mango. So equal utility, a very important. Supposing if I am deriving a value of a motor car which is 5 year old, so I can derive a value of that motor car based on the value of a 5 year motor car of same make, same model. I cannot arrive the value, or I cannot estimate the value of a motor car 5 year old with comparing that with the new motor car, value of the new motor car. So that is how we derive the replacement value or a reproduction value under the cost approach, under the cost approach. So equal utility. Buyer will pay no more for an asset than the cost to obtain an asset of the equal utility. So if we go to the fundamental economic principle behind the cost approach, so let me take you there. So that is actually the based on theory of substitution. Substitution means I will substitute a 5 year motor car with a 5 year motor car. Therefore, it is replacement value. Therefore, it is reproduction value. Therefore, it is a reconstruction value. Reconstruction value. So substitution. So that refers to the idea that asset is worth no more than the cost to obtain a substitute asset that provides the same benefit, equal utility, same benefit. That is very vital. Supposing you have a building that is 10 year old, that building is 10 year old, and if you are determining the construction cost of this 10 year building, so necessarily you need to actually estimate the construction cost of material which were prevailing 10 year back. So you cannot actually, supposing today the construction cost of a new building of similar benefits, equal utility, supposing say 100 crore. So you will not take this 100 crore as the value, replacement value of the building, because this 100 crore is arrived based on the prices which are prevailing as on today, as on today. So there necessarily you need to consider the prices of material or a cost of construction material which were prevailing a 10 year back, which were prevailing 10 year back. So that is alternative number one, or alternative number two. That is, you have arrived at the value of similar type of building going by the current material cost of the building, and then you will actually reduce this. You will actually charge depreciation and allowance for obsolescences in this. So supposing you estimate that at 20 crore rupees the depreciation, so the replacement cost of the building, that will get reduced to 80 crore. So that is what very important, worth no more than the cost to obtain a substitute asset that will provide the same benefit. And the evaluation method that are based on this principle, like the cost approach, so that will make an attempt to estimate the value of an asset by determining the cost of replacing or reproducing the asset, that is a reproduction or a replacement value, considering the depreciation and obsolescence. Depreciation and obsolescence. Very important here about depreciation, what obsolescence we are talking about. That is not as per the market value. That is not as per the books of account or the financial statement of a company. So valuer at the time of valuation need to estimate the remaining useful life of the asset at the time of valuation, and based on that the allowance for depreciation and obsolescences that will be considered. Very important. We are living in the most uncertain time. The world is changing, and world is changing at a very fast pace. The technology, the consumer preferences are changing very rapidly. We are living in the world of automation, machine language, artificial intelligence, data analytics. So, in that, actually, the technology is actually changing at a very rapid pace, very rapid speed. What technology was there 5 years back, if you compare with that today, so we can see a very wide difference in that. If you take one or two example, so once upon a time, photograph means Kodak. You cannot imagine to take a photograph without making use of one or other product of the Kodak company. Kodak company, as we all are aware, this was a multinational company. Today, you will not actually hear the name of the product company. Now, photograph very convenient. You can take through your mobile phone. Camera is not needed to take a photograph. Another example, Nokia. Once upon a time, just in the recent past, mobile set means Nokia. Nokia had captured the major market share of a mobile set market. Today, what is the market share of Nokia? We all know technology has changed. So, very important to estimate the correct life of asset or a future economic life of an asset. So, that is the a theory of substitution. Theory of substitution. So these are the three approaches to evaluation, which we discussed in a detail. Very important to understand what is market approach, what is cost approach, and what is the income approach. Under that, we have actually the different method. So very important. There are three approaches only globally recognized, but there can be multiple methods of valuation under each of these three approaches. Multiple methods of valuation under these three approaches. So actually, apart from whatever the evaluation methods are highlighted in the evaluation standard, there can be other methods of evaluation. So methods, a list of method that is not exhaustive, that is illustrative in nature. So that is just providing the examples of method. So very important to understand that. And if we talk about the market approach, so market approach, what I have done, I have highlighted the different method both under international evaluation standard and under ICAI evaluation standard. So as we all are aware, in India, the Institute of Chartered Accountant of India, they have notified, they have published their own evaluation standard. So under the market approach, international evaluation standard, we have the comparable transaction method or the guideline transaction method. So comparable transaction based on the details of comparable transaction or a guideline transaction. So comparable transaction is also known as guideline transaction. Based on that, we can derive the value of target asset or the subject asset. So that is comparable transaction method. Then a guideline, a publicly traded a comparable method. So actually, wherever we are able to get the price, prevailing price from the public domain. So we can make use of that. One example of that is like if I am making a valuation of equity shares of a listed company. That is publicly traded listed company shares that is publicly traded on the stock exchanges. So that is, I can take that as a comparable and I can do the evaluation. So guideline a publicly traded a comparable method and other market consideration. So under that we can have the rule of thumb. Rule of thumb will include various multiples, various comparable and we have actually a discount for lack of marketability, discount for lack of control, discount for block deal. So all that will be part of the other market consideration, other market approach consideration. And under ICAI evaluation standard. So as we all are aware, Institute of Chartered Accountant of India had published their own evaluation standard in 2018. So going by that, we have the market price method. So market price method and a guideline publicly traded company method. You can relate with that. Then we have the comparable companies multiple method and a comparable transaction multiple method. So you can relate this with the comparable transaction or the guideline transaction method. So that is about the various methods of evaluation under the market approach. So we will now actually go to the income approach. But before we do that, two things. Number one, it is more than 90 minutes from when we started. So if convenient to you, convenient to each one of you, we will have a short break of around 5 to 7 minutes. And then we will continue in the remaining time. And number two, before we go into for a short break, if you have any question, any query on whatever we have covered so far, or any feedback, any suggestion related to your expectation from this particular session, so that is welcome so that we can move forward in the remaining time accordingly. So any question, any suggestion, any feedback on whatever we have covered so far?
Excuse me, sir. So regarding the synergistic value,
Yeah.
will it be always more when two or three companies merge, or it may
Yes.
be less also the total output of a new company?
Generally, sir, and technically, logically also, it needs to be more. Otherwise, that is not synergistic value, sir. Synergistic value, if I again take you to the PPT, so it is specifically highlighted that is more as compared to the individual value. So that is the synergy. That is how actually that is synergy. Some synergy is created. As you can see here, sir. So I will just give me a minute. So I will actually.
Hello,
Uh,
sir.
so
Sir.
so as you can see, synergistic value is the result of combination of two or more asset or interest, where combined value is more than the sum of separate value. So this probably will provide a reply to your specific query, sir. It is highlighted more than the sum of separate values. So unless it is more, that is not a synergy.
Okay.
Sir, one more question.
Yeah, go ahead.
Yeah.
Go ahead, sir. Go ahead,
In
sir.
Naresh Gupta this side, in many company, one asset is transferred to a director as per the value written in the books of account, not
Yes.
as per the market value.
So that is not the correct approach. If you refer to the Companies Act, non-cash transaction with a director of a company, that will need the valuation report from a registered valuer, sir. Non-cash transaction. This is the example of non-cash transaction with a director of a company. So that will need a valuation by a registered valuer, and that provision is in a Companies Act. So what I will do after the break, I will highlight that provisions under the Companies Act.
Okay. Okay. Right.
That is what is your query, na? Non-cash transaction with a director of a company.
Right. But actually, they will be doing some sale deed or all that with it.
Like transfer deed to for title deed will always be required. But
Yeah.
what a value need to be considered, that should always be as per the valuation report issued by the registered valuer, sir. So
Right.
that is not book value. Book value can be less or more, but what value is determined by the registered valuer, that will matter in such transaction.
Right, sir. Right.
Any further question or a query? So it seems no further question. So Kajal madam or Sarma sir, are you there, sir? Can we have a short break of around 5 to 7 minutes and then we will resume the session?
Sure, sir.
Okay, okay, okay. So we will resume the session at around 5:43 p.m. Thank you for your attention throughout this session. So we will continue from where we left actually. And prior to going into break, Gupta Saab had one specific question related to the non-cash transaction with the director of a company. So just allow me to share means this PPT. So as you can see, sir, this section 192.2, that is subsection 2 of section 192, that is related to a non-cash transaction involving a director. So that will require a value of the asset, that will require of a valuation of the asset, and that needs to be done before effecting approval for the transaction to be executed. So that will require actually approval from the board of director of a company. So prior to obtaining the approval, the evaluation of that asset will be required. So that is very specific, sir. I will request you to refer to the provisions of subsection 2 of section 192. Subsection 2 of section 192 in that regard. So I hope that will give a reply to your specific query. Any further query, Gupta sir?
Sir, what is section 56 says about valuation?
Section
56.
56, that is not covered in this PPT, sir. We will have to go through that separately. But
Okay.
this 192 is the relevant section, non-cash transaction involving directors, sir. That is
Okay.
the specific section under the Companies Act.
Right, sir. Thank you.
Okay, so we will start from where we left. So this synergistic value we have already covered. Let me take from where we left. So market approach evaluation we have already covered, and the methods under the income approach. So we have the a discounted cash flow method. So that is common. May I request all the participant please mute whenever you are not talking. Actually, a DCF that is common under both the ICAI evaluation standard and the IVS. So DCF is the common, and then under IVS we have indirect reference of the income capitalization method. So under a DCF, actually mainly we go by the FCFF, that is free cash flow to a firm, free cash flow for a firm, or we go by the FCFA. So that is actually the basis of value, estimation of the cash flow, either for the entire firm or just limited to the equity, FCFF and FCFE. And alternative method of alternative method under DCF, that is income capitalization method. Income capitalization method. So we can take just one example, that is dividend discount model. So those companies which are making payment of a dividend at regular interval, and that is predictable. The payment of dividend is predictable based on the past history of the dividend payment. So we can make use of the dividend discount model. So that is one of the example of income capitalization method. So in short, under a DCF, the estimated value can be derived either based on the free cash flow, or based on the capitalization of the income, or based on the capitalization of the income. And then we have these three methods which are highlighted under the ICAI evaluation standard: the relief from royalty method, the multi-period excess earning method, and a with and a without method. So these methods are specifically applicable to the intangible. So with this method, actually, a valuation of tangible asset that is not feasible, that is not meant for a valuation of tangible asset. These are used for evaluation of intangible asset like patent, trademark, copyright, GI tag, etc. A question will come why these methods are not there under the international evaluation standard. So these methods are already there, but that is in IVS 210. IVS 210, as we all are aware, that is related to evaluation of intangible asset. Valuation of intangible asset. And there are 5 methods of evaluation for intangible asset under income approach in IVS. Under income approach in IVS. So apart from these 3 methods, there are 2 additional methods. Number one, greenfield method, and number two, a distributor method, and number two, a distributor method. So that is related to the relief from royalty, multi-period excess earning with and without method. And then we have this option pricing method. So that is a financial instrument that is a derivative contract, option contract, and that is contingent in nature. So you all are aware, a holder of the option contract, whether that is the put contract or that is any other. So that will be based on that will be exercised by the holder of the contract only when that is beneficial to the contract holder of the contract. So option pricing method, that is contingent in nature. Contingent in nature. So exercise of the option contract, that will depend on whether the holder of the option contract is getting a profit, is gaining out of execution of the contract, then only he will opt for execution. So that is contingent in nature, that is related or based on a future event. So therefore, it is a contingent method, and you must have heard about the binomial method of option pricing. You must have heard about the Black-Scholes method of option pricing, the Monte Carlo simulation method of option pricing. So mainly this is used for evaluation of option contract, but we can make use of option contract in evaluation of equity also, because equity is also a contingent in nature. We can also make use of valuation of entire enterprise. So through the option pricing method, we can also make use of that for evaluation of equity and enterprise. So that is about the income approach, and we have the cost approach. And under that, 2 main method that is common: replacement and a reproduction cost method. So these are common, and we discussed about that. And we have third method, summation method, under the international evaluation standard. So summation method, that is used, if I give 1 or 2 example of that, so that is used for evaluation of group company. So a group company consisting of principal company and the subsidiary company, you will appreciate that the characteristic of the group company and the subsidiary company, the business model of the group company and subsidiary company, that will be different, and therefore that will need the separate valuation. And separate valuation. So a valuation of principal company will be done separately, subsidiary company will be done separately, and then those value will be added. So that is known as the summation method, because we are adding the value of a principal company and the subsidiary company. Like that, if actually one company is having a multiple business. One company is having a multiple business, like one company is dealing in FMCG business, in a retail business, in telecommunication business. So a different types of business, and you will appreciate that the characteristic of each of these business that will be different, that will not be identical, and therefore each of a business will require separate valuation. So that will be done, and once that is done, so that will be added together to arrive the value of entire company. So that is the summation method of evaluation. So these are the different method, and this we have already discussed, and a very important, the a choice of valuation approach, a choice of valuation approach. So this is the selection process for actually a choice of valuation approach and evaluation method. So very important. No one method is suitable in every possible situation. So the method of valuation, the approach of valuation, that is not predetermined, that is not general in nature, that will be based on ground reality of each evaluation assignment, each evaluation estimation. And then question will come how to select the appropriate approach of valuation or the evaluation method. So guidance on that is provided under a para 10.3 of IVS 105, which is on introduction. So selection process need to consider at minimum. So very important. These are the minimum requirement, illustrative in nature, not exhaustive. Apart from this, there can be other requirement also. So that is very important. At minimum, the appropriate basis of value and premise of value. So in the beginning only we discussed, unless the basis of value or the premise of value, going by guidance provided in IVS 104, that is determined, that is selected by the evaluator. We cannot determine the evaluation approach or the evaluation method. So selection process of valuation approach or evaluation method, that will depend on a selection of appropriate basis of value and a premise of value. So that is subsequent event. Prior event is a selection of appropriate basis of value and premise of value, determined by the terms and purpose of the evaluation assignment. So basis of value and premise of value, that will be determined based on the terms and purpose of the valuation. Supposing the purpose of valuation, that is transfer of business, and a transfer of business, so appropriate basis of value is the market value. You will determine the market value. You will not determine the liquidation value. Liquidation value we will determine when the company is under winding up process or under the dissolution process. So that is very important. Basis of value determined based on the purpose of value and a respective strength and a weakness of the possible evaluation approach and method. So if I am selecting the market approach, whether that is that is appropriate, so that I will determine based on the strength and weakness of the market approach in that particular situation. So that is consideration number two, and appropriateness of each method in a view of the nature of asset and approaches or a method used by a participant in the relevant market. So again, very important when you are doing the evaluation of land and building. So generally, majority of the cases, the evaluator follow the market approach. They don't go by the income approach of valuation. They go by the market approach. So that is actually very important to ascertain what actually approaches or method are used by the participant in the relevant market, and availability of reliable information needed to apply the method. Unless the data are available, unless the information is available, unless the details are available, we cannot make choice of a evaluation method or approach. So that is about the selection process of appropriate evaluation approach and a method. So actually, I have a lot more to cover. Probably even if we talk about next 3 to 4 hours, this subject will not be complete. You all will appreciate that is having a very wide coverage. Actually, I will not bother you much on this weekly of day. Majority of you may have the weekly of day on a Saturday. Since actually the time of this particular session is over, so I will end here, and I thank each one of you for your attention throughout this session and making this session as interactive session. And before we end the session, if you have any further question or query or feedback, so that is welcome. Otherwise, we will end the session here.
Thank you very much, sir.
Thank you, sir. Thank you.
Thank you.
Thank you. Please share PPT. So I will definitely share the PPT with the organizer of this event, and in turn you will get that. Thank you, Charu madam. Thank you for your kind words. So Sarma sir, it seems no question.
Yes,
So,
yes.
so
Yes,
we
sir.
will-
Yes, sir.
Yeah, yeah.
So as no questions are there and time also for the CEP is coming to end. So we wind up this program here. Thank you very much, sir, for your a nice speech, a nice lecture. You have covered the topic very nicely, and thank you very much, sir. And thank you, Kajal, for thank you, participants, for your participation. Please share your feedback. Thank you, Kajal, for your support. Thank you, sir.
Thank you, sir. Thank you, every participant.
Thank you.